Hello everyone. Today we are looking at the market week from June 1st to June 5th, 2026. But this is not just a simple weekly market recap. This week gave us a very clear message. Markets may still be creating opportunities. But behind every opportunity, there is now a much tougher pricing environment shaped by interest rates, liquidity, the US dollar, and risk appetite. From the outside, the technology story still looks powerful. Artificial intelligence investment is still at the center of the market narrative. Large technology companies are still carrying a significant part of the global equity story. But this week's price action reminded us of something very important. No matter how bright the outer surface of a building looks, the real question is always the strength of its foundation. I read today's market environment like a skyscraper. The glass surface looks impressive. Technology stocks, artificial intelligence, data center investment, mega cap companies, and future growth expectations all create a very powerful image from the outside. But the foundation of this building is liquidity. And the main supporting columns are interest rates, inflation, earnings quality, valuation discipline, and risk appetite. This week, we saw how much stress those columns are carrying, because the main theme of the week was very clear. After the strong US employment data, markets started to reprice the interest rate path higher. The US 10-year Treasury yield moved up, the dollar strengthened, the S&P 500 and the Nasdaq 100 sold off sharply, precious metals came under pressure, and in crypto assets the sell-off was even deeper. On the global side, the main break came after the US employment data. According to Reuters, Wall Street fell sharply on June 5th. The S&P 500 declined by 2.64%. The Nasdaq Composite fell by 4.18%. The Nasdaq 100, which we are tracking closely here, dropped by 4.77% on June 5th. The US 10-year Treasury yield rose to 4.536%. DXY strengthened, and Eurodollar moved down to 1.1521. This is the core of the week. Good economic data became bad market news because strong employment reduced the probability of near-term Federal Reserve rate cuts. And when rate cut expectations weaken, the entire valuation framework changes. The S&P 500 closed the week at 7,383.74. The daily closing levels were 7,599.96, 7,609.78, 7,553.68, 7,584.31, and finally 7,383.74. The main break came with a 2.64% decline on June 5th. RSY14 stands at 44.9. This tells us that short-term momentum has weakened, but the index has not yet entered the classic oversold zone. On the downside, the first support area is between 7,368 and 7,350. 7,300 is the psychological support level. On the upside, the first resistance area is between 7,540 and 7,620. The break scenario is clear. A close below 7,350 could deepen the correction toward 7,300 and below. A move back above 7,540 would show that Friday's sharp sell-off is being absorbed, and the index could retest the 7,600 to 7,620 zone. The picture is more severe in the Nasdaq 100. The index closed the week at 28,957.60. The closing sequence was 30,513.86, 30,660.60, 30,571.24, 30,407.81, and finally 28,957.60. The 4.77% decline on June 5th became the defining move of the week. RSY14 is at 46.7. Momentum has deteriorated, but RSI is still not in oversold territory. This means that for the sell-off to deepen, the support area between 28,930 and 28,820 needs to break. On the upside, 30,000 and 30,670 are the key resistance levels to watch. A close below 28,820 would open a wider correction area for technology stocks. A reaction above 30,000 would indicate that the sell-off may have been more of a short-term panic move. The broader point is this: the technology rally is not an empty story. Artificial intelligence, data center investment, strong earnings, and order books are still real, but pricing has become much more sensitive. The key pressure point behind this sensitivity is the US 10-year Treasury yield. The US 10-year yield closed the week at 4.536%. During the week, it moved between 4.455% and 4.536%. It rose after the strong employment data on Friday. RSI 14 is at 62.8, so the momentum in yields is upward, but not yet in the overbought zone. 4.55% is the first resistance level. 4.69% is the broader resistance level. On the downside, the support band is between 4.45% and 4.42%. The break scenario is important. A close above 4.55% would support a new move toward 4.69%. A move back below 4.42% would help reduce the discount rate pressure on risk assets. Here's the key mechanism. When Treasury yields rise, the present value of future corporate cash flows declines. In simple terms, the discount rate goes up, and this creates serious pressure on technology and growth stocks. On the dollar side, DXY also strengthened. The dollar index closed the week at 100.07. During the week, it rose from 99.20 to 100.07. On June 5th, it reached an intraday high of 100.11. RSY 14 is at 77.1. This is close to, and technically inside, a strong momentum zone for the dollar. It also means that the risk of a short-term technical correction has increased. The support area is between 99.16 and 98.90. The resistance levels are 100.11 and 100.64. A close above 100.64 could start a new upward leg in the dollar index. A move below 99.16 would show that the dollar rally is getting tired in the short term. Euro-dollar closed the week at 1.1521. At the beginning of the week, the pair was at 1.1631. By Friday, it had fallen to 1.1521. The intraday low was 1.1517. RSY 14 is at 28.6. This is close to oversold territory. The strengthening in DXY and the rise in US Treasury yields created pressure on the pair. 1.1517 is the first support level. 1.1370 is the broader support level. The resistance levels are 1.1645 and 1.1797. A close below 1.1517 could trigger a move toward the 1.1370 support. A move above 1.1645 would show that the weekly dollar-driven break is weakening. The global technical watch list is as follows. For the S&P 500, support is between 7,350 and 7,300. Resistance is between 7,540 and 7,620. A move above 7,540 would support a recovery. For the Nasdaq 100, support is between 28,930 and 28,820. Resistance is between 30,000 and 30,670. A move above 30,000 would support a reaction. For the US 10-year yield, support is between 4.45% and 4.42%. Resistance is between 4.55% and 4.69%. A move above 4.55% would increase rate pressure. For DXY, support is between 99.16 and 98.90. Resistance is between 100.11 and 100.64. A move above 100.64 would confirm stronger dollar momentum. For euro-dollar, support is between 1.1517 and 1.1370. Resistance is between 1.1645 and 1.1797. A move below 1.1517 would deepen euro weakness. Now let's move to precious metals. Normally, in periods of uncertainty, we expect gold and other precious metals to remain relatively strong. But this week, strong US employment data and higher interest rate expectations created heavy selling pressure across the precious metals complex. According to Reuters, gold fell by around 3% on June 5th. Spot silver, platinum, and palladium also saw sharp losses. COMEX gold closed the week at $4,365.30. Silver closed at $69.103. Platinum closed at $1,797.90. Palladium closed at $1,263.60. COMEX Gold closed the week at $4,365.30. On June 5th, gold fell as low as $4,336.70 and recorded its weakest close of the week. RSI 14 is at 30.0. Technically, gold is right at the edge of oversold territory. The first support band is between 4,336 and 4,300. On the upside, resistance levels are 4,500 and 4,593. 4,627 is the stronger upper resistance level. The break scenario is clear. A close below 4,300 could deepen the correction toward the 4,200 to 4,250 area. A close above 4,500 would indicate the start of a short-term reaction move. Silver closed the week at $69.103. During the week, it fell from $75.254 to $69.103. The intraday low on June 5th was 67.700. RSI 14 is at 36.4. The selling pressure is clear, but silver is not as close to oversold territory as gold and platinum. 67.70 is the first support level. 65.00 is the psychological support level. The resistance band is between 73.97 and 75.55. A close below 67.70 could extend the sell-off toward the 65.00 area. A close above 74.00 would strengthen reaction buying. Platinum closed the week at $1,797.90. During the week, it fell from $1,928.40 to $1,797.90. On Friday, platinum dropped by 5.37%. RSI 14 is at 29.4. The technical picture is close to oversold territory. The support area is between 1,770 and 1,750. Resistance levels are 1,900 and 1,945. A close below 1,770 would open a new selling area toward the 1,700 to 1,750 band. A move above 1,900 would be the first condition for a stronger reaction move. Palladium closed the week at $1,263.60. On June 5th, it touched an intraday level of $1,236.75. The weekly loss became more visible by the end of the week. RSI 14 is at 25.7. This is clearly in oversold territory. The trend is weak, but the short-term reaction potential has also increased. The support area is between 1,236 and 1,200. Resistance levels are 1,335 and 1,390. A close below 1,200 would increase the risk of a deeper decline. A move above 1,335 would be the first technical signal that selling pressure is weakening. The main message in precious metals is this: when yields rise and the dollar strengthens, even gold can come under short-term pressure. For gold, the key area is between 4,300 and 4,500. For silver, the key area is between 67.70 and 74.00. For platinum, the key area is between 1,770 and 1,900. For palladium, the key area is between 1,236 and 1,335. These levels will be the main technical zones to watch next week. Now let's look at the crypto market. This week, the sell-off in crypto was much sharper. Reuters reported that Bitcoin fell by around 15% for the week and has shown weak performance in 2026. The Wall Street Journal also reported that Bitcoin tested below $60,000 on Friday. Bitcoin closed June 6th at $60,874.9. Ethereum closed at $1,557.83. XRP closed at $1.0909. Bitcoin closed June 6th at $60,874.9. The June 1st close was $71,398.8. The June 5th close was $60,979.3. The June 6th close was $60,874.9. During the week, Bitcoin traded as low as $59,159.3. RSI 14 is at 12.8. This is a very deep oversold zone. It shows strong downside momentum. At the same time, technically, it also means that the probability of a short-term reaction has increased. The support levels are 60,000 and 59,159. On the upside, the resistance levels are 63,900, 66,700, and 71,400. A close below 59,159 would increase the risk of a new decline toward the 55,000 to 57,000 band. A move above 63,900 would be the first reaction signal. A close above 66,700 would provide stronger confirmation that the selling trend is weakening. Ethereum looks even weaker than Bitcoin. Ethereum closed the week at $1,557.83. The June 1st close was $2,006.81. The June 5th close was $1,582.06. The June 6th close was $1,557.83. The weekly low was $1,542.12. RSI 14 is at 10.5. This is an extremely deep oversold zone. The technical picture in Ethereum is weaker than Bitcoin. Support levels are 1,542 and 1,500. Resistance levels are 1,770, 1,860, and 2,007. A close below 1,542 could accelerate the move toward 1,500 and 1,388. A move above 1,770 would be the first sign that selling pressure is easing. XRP closed the week at $1.0909. The June 1st close was 1.2973. The June 5th close was 1.0977. The June 6th close was 1.0909. During the week, XRP traded as low as 1.0707. RSI 14 is at 19.6. XRP is also in oversold territory. The short-term technical structure is weak. 1.07 is the first support level. 1.00 is the psychological support level. Resistance levels are 1.17, 1.21, and 1.30. A close below 1.07 would bring a test of 1.00 onto the table. A move above 1.17 would be the first positive signal for a short-term reaction move. The main message in crypto is this: when risk appetite weakens, the highest beta assets usually react the hardest. This week, that is exactly what we saw. Bitcoin, Ethereum, and XRP all moved into very clear oversold zones. Their RSI levels were 12.8, 10.5, and 19.6 respectively. This increases the probability of a short-term reaction, but it does not automatically mean that the main trend has improved. The trend is still weak. Now let's read all asset classes together. This week, the US 10-year Treasury yield rose to 4.536%. DXY moved up to 100.07. Eurodollar fell to 1.1521. The S&P 500 declined to 7,383.74. The Nasdaq 100 fell to 28,957.60. Gold dropped to $4,365.30. Silver fell to $69.103. Platinum declined to $1,797.90. Palladium moved down to $1,263.60. Bitcoin fell to $60,874.9. Ethereum dropped to $1,557.83. XRP declined to $1.0909. This table tells us one clear thing. Liquidity, interest rates, and the dollar are back at the center of the market. Strong US employment data looks positive at first glance. It suggests economic strength. It suggests that consumers still have income. It suggests that the economy is not collapsing. But the market read it differently, because strong employment means the Federal Reserve may delay rate cuts. And if high rates stay higher for longer, the valuation environment changes. Higher interest rates mean higher discount rates. Higher discount rates mean lower present values for risky assets. And lower present values mean pressure on equity valuations, precious metals, and crypto assets. That is why technology stocks, precious metals, and crypto assets all came under pressure at the same time this week. Normally, these asset classes do not always move together, but when the main shock comes from rates and the dollar, selling pressure can spread across many different markets. My interpretation is this: the market is not yet fully pricing a collapse scenario. But we are no longer in a comfortable risk-on environment either. On one side, we still have the artificial intelligence story and strong corporate earnings. On the other side, we have higher yields, a stronger dollar, elevated valuations, liquidity risk, and weaker risk appetite. In this environment, the most important word is selectivity. A strong narrative is not enough. A strong balance sheet is not enough. Investors need to read liquidity, interest rates, technical levels, and portfolio risk together. For next week, these are the main break areas I will be watching. For the S&P 500, 7,540 is the recovery threshold. 7,350 is the level below which the correction can deepen. For the Nasdaq 100, 30,000 is the reaction threshold. 28,820 is the level below which a broader technology sell-off can develop. For the US 10-year yield, 4.55% is the key level. A move above that level would increase rate pressure. For DXY, 100.64 is the key upside level. A move above that level could confirm a new upward leg in the dollar. For Eurodollar, 1.1517 is the key downside level. A break below that level would deepen euro weakness. For gold, a move above 4,500 would support a reaction. A move below 4,300 would suggest a deeper correction. For silver, a move above 74.00 would support a reaction. A move below 67.70 would open the way toward the 65.00 area. For platinum, a move above 1,900 would support recovery. A move below 1,770 would open a new selling area. For palladium, a move above 1,335 would support a reaction. A move below 1,200 would increase the risk of a deeper decline. For Bitcoin, 63,900 is the first reaction threshold. A close below 59,159 would increase the risk of a new decline toward the 55,000 to 57,000 band. For Ethereum, 1,770 is the first recovery threshold. A close below 1,542 would create risk toward 1,500 and 1,388. For XRP, 1.17 is the reaction threshold. A close below 1.07 would bring 1.00 into focus. So, as of June 6, 2026, the weekly market picture can be summarized as follows. Risk appetite weakened. The dollar and treasury yields strengthened. Technology stocks and crypto assets sold off sharply. Precious metals declined under the pressure of higher rates. The main market signal is clear. This is not a market where investors can rely only on excitement. This is a market that requires discipline. Opportunities may still exist, but they are now more expensive, more selective, and more fragile. On one side, we have the artificial intelligence rally and strong corporate stories. On the other side, we have high interest rates, a strong dollar, elevated valuations, liquidity risk, and weaker risk appetite. That is why making decisions based on a single data point is not enough. When looking at technology stocks, we need to watch the US 10-year yield. When looking at gold, we need to watch the dollar index. When looking at crypto, we need to watch the direction of overall risk appetite. And most importantly, we need to remember this. Every strong story has a price. When the price rises too far, the risk changes even if the story remains strong. The views shared in this video are not investment advice. My goal is to frame the market picture of the June 1st to June 5th, 2026 week in a clearer, simpler, and more strategic way. See you in the next video.